Welcome to my YouTube channel. Today I am starting a new series in the Wonderland of investment. In my opinion, stock investment is certainly a wonderland. There are people who have created their fortune in this market. Persons like let's see Rakesh Dununbala, Ramesh Damani, Ramdev Agarwal, and many more. There are other set of people who have come to the market, experimented, burnt their fingers, not only burnt their fingers, burnt both the hands and went away with a very sad experience. Why it happens? The endeavor here is to bring to you pearl of wisdoms from the most famous books written on investment world over. I hope those wisdoms, those pearls of wisdoms will give you certain insights which will help you avoid burning your fingers and hands. Therefore, this new series. So today, I am starting a new book, A Random Walk Down Wall Street, written by Burton Malkiel. This is a very famous book, and I recommend every serious investor to read this book whenever they get time. So if you're not getting time, never mind. I am going to bring to you certain pearls from this book, which I hope will be very helpful in your investing journey. So let's get going. So before I start, the question comes, till you read this book or till you get all the pearls from this book or other books, what to do? Should we not invest or keep on investing in some way? I'll answer your question in a while. The best way to invest before you really get all the wisdoms or all pearls of wisdom from this book and other books, or you will become really knowledgeable. People say that mutual fund could be a good way of investing. It is. But a recent study showed that 2/3 of the fund managers of mutual fund, they perform poorly compared to the market. Now, this is very alarming. This means 2/3 fund managers performed less than market. Now, this being the case, then one has to be very cautious in terms of investing. And I think before I do it here, this has to be mutual fund, and this is a route to the mutual fund. So here in mutual fund, 2/3. Now let's talk about Indian mutual fund industry. Indian mutual fund industry is growing very rapidly. As of today, the number of folios is more than 14.11 crores, which is a very hopping number. And every month, around 10,000 crores is being poured in to the market using SIP. The second fact, which is very important to note, is the AUM or size of the mutual fund investment in the market is rupees 40.76 lakhs crores. Third very interesting aspect is when you look at the number of funds, there are more than 7,500 active funds. Now, given these data and knowing that when 2/3 of the fund managers are not able to perform better than the market, it creates a doubt in the mind of investors. So what you should be doing? Either you should be able to select 1/3 of the fund managers, which is very hard, which is very difficult. Maybe on your track record you can do that, but even track record doesn't guarantee that those managers are going to perform good in future as well. Then what is the other way? So other way of investing is what I say, buying the market, and that is known as index fund investing. Now index fund are set of funds, it's like mutual fund, where they mimic the market. There is no selection like typically they do in mutual fund. So here expense ratio becomes very low, and therefore index fund will go with the market performance. Over the long term, it has been seen that index fund has been growing at around 13% plus. So if you invest through index fund, you will get a CAGR of about 13%. Not in 1 year, 2 years. You have to have 10 plus years investment horizon. Because staying long in market is the key. So therefore, friends, you have choices between zero index fund, 100% mutual fund, or 100% index fund, zero mutual fund, or anything in between, a combination thereof. So if you choose to have a combination, it is very important to get hold of a very good distributor who is almost selfless, which is very hard to find today. But there are people who do the work for their passion and you can take their advice. Well, they will get some commission, but commission is just incidental. Their main goal is to serve the people and help them grow with the market. And then also, I think there should be some allocation in the index fund. And both of them, you should be able to leave it for long term. Long term means minimum 5 years, 10 years, 15 years, 20, 25 years type of time frame. If you do this, you will certainly create a huge wealth for you and your family and retire peacefully. So I hope you like today's series and today's deliberation. I'll bring Pulse of Wisdom from this book one by one. And once this book is over, I'll pick up the other book. That's the way I'm going to go forward. If you have not subscribed to this channel, please do subscribe to the channel because your subscription is going to help the channel to grow. And share this video to your friends and families. Let them also benefit from the Pulse of Wisdom and enjoy the investing journey. Thank you so much for your time and see you next time.